Hey, Dan Passarelli here. I am often asked about something called pin risk. Now, this may be something that you've heard about, and it is a potential problem, but it can be avoided. So, let's talk about what is pin risk and how to avoid it. So, every month or week, or in some cases, day, we have options expire, right? So if we're long options, we get to decide whether or not we want to exercise those options after the bell rings at on expiration day. But if we're short options, we don't have a right, we have an obligation. And if someone who is long that option decides to exercise them, then we are compelled to comply. The clearing firm and consequently our brokerage firm automatically exercise that, and we end up getting a stock position. So most of the time, we know when we're going to get assigned. It's always advantageous for the owner of an option to exercise it if it's in the money, whether that's a call or a put. And so if the option is in the money, even by a penny, we can safely assume that option is very likely, almost certainly, going to be exercised. In fact, it gets automatically exercised if it's in the money by a penny. But what if it's right at a strike price, exactly at the money, not in or out? What happens then? Well, then we don't know. And the person who's long it, in this case, the person on the other side of the trade is usually a market maker. Well, that market maker will then decide whether or not he or she needs to exercise those options. And backstory, the reason why they might exercise or might not is it depends on how many shares of stock they have hedged against it. If it's 50% hedged, they'll exercise 50% of their long positions. If it's 100% hedged, they'll exercise all of them. If it's 0% hedged, they'll exercise none of them and everything in between. So the bottom line is we don't know if we're going to get assigned. Now, imagine you're short an option, it goes out right at the strike, and you assume you're not getting assigned, but you do get assigned, and next thing you know, you come in Monday morning short 2,000 shares of stock, and the stock gaps up higher 10%. This is not an everyday occurrence, but I've seen it happen, and it can. And Murphy's Law says at some point it will. So we don't want to be short options right at the strike price on expiration day. We can earlier in the morning, but we've got to be out of it by the end of the day. So pin risk is just simply the risk of not knowing whether or not you will get assigned because the stock is right at the strike price. And how we avoid it? We just buy them back. If we wait until the last 10 minutes of the day, we can usually buy those puppies back at about, a nickel or even less. And if you sold them previously, you probably sold them for more than a nickel. So you're just locking in a profit anyway, and you're taking risk off the table. I hope that helps. This is Dan Passarelli, Trade Smart.